Hi everyone, welcome back to my channel. In this video I'm sharing a few definitions in banking sector. These definitions are helpful for upcoming interview section for IBPS PO and also Union Bank of India LBO. So only these are the banking definitions because it is based on banking sector, so that's why only few banking definitions I collected from various sources. So I suggested a good plan in textbook app, that is future officers sale. It starts from this month onwards. In this sale, yearly textbook pass pro actual price is $6.99. By using my coupon code TESA12 to get 12% offer on this $6.99, then you will save nearly 90 rupees by using my coupon code TESA12. Then you got for 615 rupees only. So this is a very good platform to purchase a good mock test series. We have SBA clerk and SBA PO notifications ahead. So that's why I suggested this plan, and don't miss this opportunity and don't miss by using my coupon code TESA12. So first of all, what is liquidity? So it is a liquidity in banking sector is a financial institution ability to meet its financial obligations and fund assets. So what is liquidity? It means, so it is defined in banking sector is a financial institution ability to meet its financial obligations and fund assets, and also it is important for banks to have enough liquidity to meet customer withdrawals and compensate for balance sheet fluctuations and provide funds for growth. And also banks can measure their liquidity using ratios like current ratio, quick ratio and cash ratio. So first definition is about liquidity. So it is a financial institution ability in banking sector to meet its financial obligations and also fund assets. It is important for banks to have enough liquidity to meet customer withdrawals and also compensate for balance sheet fluctuations and provide funds for growth. So how we can measure this liquidity is three types. So first one is current ratio and quick ratio and cash ratio. So first of all, current ratio. What is how to define current ratio? It is a current assets divided by the current liabilities. So we will define this current ratio is current assets divided by current liabilities. So current assets divided by current liabilities to get the current ratio. And next one is quick ratio. So this is the cash, accounts, receivables and marketable securities divided by the current liabilities. So quick ratio means cash, accounts, receivables and also marketable securities divided by the current liabilities. And last about cash ratio. So what about how to define this cash ratio is cash and marketable securities divided by the current liability. So this is all about liquidity. Okay. Next, banks can keep some of their liquidity as cash in their vaults, but most of it's kept in accounts with the central bank. These funds are often called as the central bank reserves. So one more question, there is a probability of chance in what we will define the central bank reserves. So it means banks can keep some of their liquidity as cash in their vaults, but most of it is kept in accounts with the central bank. So these funds are often called as the central bank reserves. And second one, that is, it is very important, that is what is LAF. So LAF means, abbreviation of LAF is liquidity adjustment facility. So it is a monetary policy tool used by central banks to manage liquidity in banking system. So it is a monetary policy tool used by this LAF tool is used by central banks. So which purpose? To manage liquidity in banking system. So it is primarily used by the RBI. Okay. LAF allows banks to borrow funds from the central bank on a short-term basis through the repurchase agreements, that is repos, and also lend money to the central bank through reverse repo agreements. Okay, so this is all about liquidity adjustment facility. So once again we recall it. LAF means it is a monetary policy tool used by central banks to manage the liquidity in banking sector. So it is primarily used by RBI. This LAF allows banks to borrow funds from the central bank on a short-term basis through repurchase agreements and also lend money to the central bank through the reverse repo agreements. And how it helps to banks, how LAF helps to banks means adjust day-to-day mismatches in liquidity and also resolve liquidity issues and also maintain stability in the financial system and manage inflation by increasing or decreasing the money supply. Next, the RBI introduced LAF in 1998. So it is very important. When will RBI introduced LAF? So that is answer is 1998 as a result of the Narasimhan Committee. Under which committee? Narasimhan Committee on Banking Sector Reforms. LAF is made of two components, that is repo rate and also reverse repo rate. So these are also very important in banking. What is repo rate and also what is reverse repo rate. And next definition is about a marginal standing facility, that is short term is called MSF. So what is MSF? MSF is a scheme that allows banks to borrow funds from the RBI in an emergency purpose. And the purpose of MSF is a monetary policy tool that helps the RBI absorb excess liquidity in the banking system and also overcome the liquidity shortages. Okay, next. So how it works and how it is used. So all these things we will discuss now. So this MSF, it works as banks can borrow funds overnight at the MSF rate which is higher than the repo rate. So MSF rate which is higher than the repo rate, and how it is used means banks use MSF when interbank liquidity dries up completely. This scheme is launched by the RBI in 2011 to 12. Okay, and next, so what is repo rate? Repo rate is the rate at which the RBI lends money to the commercial banks. The purpose of the repo rate is to increase the money supply in the market, and also when the repo rate is lowered, the money supply increases, and when it is raised, the money supply is decreases. So it is inversely proportional. One is increases and other is decreases. Okay, next. So what about a reverse repo rate? The rate at which commercial banks lend money to the RBI. The purpose of the reverse repo rate is to decrease the money supply in the market. So repo rate is means increase the money supply in the market. So this is a short way to recall the repo rate means increase money supply in the market is called repo rate, and decrease the money supply in the market is reverse repo rate. Okay. Next, what is bank rate? So bank rate means the bank rate is the rate of interest which is charged by a central bank while lending loans to a commercial bank. So bank rate is a rate of interest which is charged by a central bank while lending loans to a commercial bank. Okay, next important one is account. So what is an account and derive an account? An account is a record of transaction between two parties. It is either customer or bank. I think two parties means transaction between bank and the customer is called account, or a record of transaction between any two parties. Next, what is ATM? So ATM means a machine that allows users to withdraw and deposit cash and check their balance and more. So a machine that allows users to withdraw and deposit cash and check their balance and more. So how many types of ATMs means? So there are yellow, green, I think orange, pink. Okay, I think green is for agriculture, pink is for women, and orange is for stock market, I think. Okay, so I don't know exactly. Next, what is annuity? A fixed amount of money paid to someone each year, usually for life. What is annuity means? It is annual amount paid to someone each year. So annual means it is a year. A fixed amount of money paid to someone each year, usually for life. And next definition is, what is assets? A resource with economic value that an individual, corporation or country owns or controls. What is assets means? A resource with economic value that an individual, corporation or country owns or controls. Next, what is bank credit? A loan from a bank to a customer. A loan from a bank to a customer, such as through discounting owns or controls. So this is bank credit. And what is bank note? A note issued by a bank that promises to pay a specified amount of money when presented. So this is all about bank note. And what is check? An unconditional order to a banker to pay a specific sum of money to the order of a certain person or to the bearer of the instrument. So this is called check. So this is all about today video. Only few definitions I discussed in this video. So remaining definitions we will discuss in next video.